So what is the difference between a primary and a secondary market? Well, a primary market is the market for newly issued securities. In other words, if there's a startup, it hasn't had any sort of public security traded ever, now it has decided to issue its first common stock, that is going to be a primary market transaction. It's going to issue these new securities through an underwriter, which is to say that investment bank. And the investment bank will help market these securities to the public. Now, a secondary market is a place for investors to trade previously issued securities among themselves. So let's say this IPO went off, and now this common stock has been trading for some time, and somebody who bought into the IPO now wants to sell their share. Well, they're going to sell that share in the secondary market to another investor. There's no new security being issued. There's no underwriter. They simply participate in an exchange market, find a willing buyer, and make the transaction that way. So primary market is for the issuance of new securities. The secondary market is for the trading of previously issued securities between investors. So how do firms actually issue securities? And what types of firms and types of securities are there? Well, first of all, there's private firms. They still can issue securities, they're just not public securities. It used to be that a private firm had up to 499 shareholders. Once you reached 500, you were no longer considered a private firm. You had to register as a public firm. Now, since the Jobs Act of 2012, that limit has actually been raised from 499 to 2,000. You can have 2,000 shareholders. Before you must register as a public firm. But generally the process is similar enough in the sense that until you reach that threshold, you're a private firm. You can raise funds through private placement. In other words, you can just find your own investors, make whatever agreement with them that you want, write whatever debt or equity contracts you like, and you don't really have to report anything to the public and not much to the government other than your taxes. So these sorts of companies raise funds through private placements. Individuals that sort of buy and sell or invest assets in the public markets may never actually know about any of these private placements, which of course then comes with the downside of lower liquidity. Remember, liquidity being the idea of being able to get in and out of a security quickly, being able to find a willing seller if you're a buyer, or buyer if you're a seller. Well, if you're doing this sort of privately without any centralized market, obviously there's going to be fewer of these buyers and sellers for you to find, so the liquidity is going to be lower. But why do some firms choose to remain private? Well, mostly because they have less supervision and fewer obligations to release financial statements. Unlike a public firm, which must release quarterly financial statements, quarterly reports to shareholders, and of course annual ones. A private firm doesn't have to do this, which some would consider to be a good thing in the sense that it frees up the private firm to really pursue long-term goals without worrying about appeasing shareholders for the next quarter. But that comes with the trade-off of maybe less oversight and therefore more room to actually make bad decisions. So there's essentially self-selection. Some firms choose to value this relative lack of supervision and become private or stay private, and some firms prefer more supervision but greater access to liquidity and more investors in the public markets, and they become public. So what happens if a company does become public? Well, it issues securities that are visible to everybody. They're marketed by underwriters, which are, again, usually investment banks. And these come in two flavors. There's the initial public offering, which is to say the first issue of shares. And there's also a seasoned equity offering, which is to say any subsequent issue. So you might have a firm that actually will issue equity multiple times. Only the first time would be considered an IPO. All of these other ones would be considered an SEO, a seasoned equity offering. But in all cases, what it's really doing is just selling more common shares. Remember, common shares essentially represent control and ownership of the company. Well, control if you can get enough votes at a shareholder meeting, but definitely ownership. But the initial public offering is special mostly because there's no precedent for it yet. The company has never been traded before. For a seasoned equity offering, it is generally pretty clear what the price the company should trade at is, because you already see what prior equity issuances have been trading at. And that means that since these issuances are marketed to the public, there's more supervision, and specifically they must be registered with the Securities and Exchange Commission, and they have to satisfy certain requirements. So how does this generally work? Well, the firm that wants to raise capital contacts usually an investment bank to be the underwriter. The combination of banks and bankers will be the underwriting syndicate, and they will be the ones that market this new issue, whether it's a IPO or an SEO or an issuance of public debt to individual investors. One special type of security registration that you can make with the SEC is what's called a shelf registration through SEC Rule 415. Now this is SEO only, so you can't do this for an IPO. You can only do this for an SEO, a seasoned equity offering. And essentially what you say is, I will set aside a certain amount of security, be it debt or equity, and I will sell it to the public for a certain amount of time, up to 3 years. So a shelf registration is good for 3 years. Now, why might you want to do this? Mostly if you want flexibility. You can sell a certain amount of of security on short notice, and you can sell it in small amounts without incurring the high flotation cost. Flotation is essentially the cost of issuance, and it's also charged by those intermediaries that help with issuance in general, the investment banks. So the reason that we call this a shelf registration is you've literally set some securities aside on a shelf, as it were, and now what you're doing is you're taking them off bit by bit and selling them as necessary when you need capital. Now, how does an IPO work? Remember, these shelf registrations don't really work for IPOs. For an IPO, you have to have a more sort of broadly publicized process, and usually consists of first roadshows to publicize the new offering, to solicit interest. In other words, to provide detail about the issuer. Book building to determine demand for the issue. This is sort of a large part of what the underwriter actually contributes in terms of value. They actually gather information from large institutional investors about how much of the prospective offering they might like to buy. By the way, why would an institution disclose how much they want to buy in advance? Well, the incentive is underpricing. So if you say you will buy a certain amount at a certain price, well, the bank can simply offer you a lower price to encourage you to actually make that sort of commitment. And the reason that this is valuable is because by actually figuring out how much enthusiasm there is for a certain IPO, that can actually give very valuable pricing information for the firm and for the bank helping it with the offering. Because otherwise, if you don't know how much demand there is, then you may actually inadvertently set the wrong price. Remember, the price of any financial security is essentially set at the intersection of demand and supply. A company will know its demand. It knows it wants to issue a certain amount of a financial security. So this part is okay. But it doesn't really know how much supply there is. And this book building process helps them understand that. Now, the underwriter actually bears some price risk. A primary or a big one is simply that IPOs are often underpriced, both to encourage the book building process as well as simply to encourage more buying of the IPO relative to the price at which the IPO could be marketed. And if the underwriter sort of commits to sell all of these IPO shares, well, it better had line up enough buyers to actually do it. So Groupon, for example, had an underpriced IPO. That means that it could have actually, each share could have been sold for more, but they were definitely all sold. An example of an overpriced IPO would be Facebook, simply because, well, it turned out the price was actually higher than the shares were actually worth. And sometimes, if the IPO can't be fully sold to market participants, then the underwriter is actually in substantial trouble.